On January 28, 2026, the price of gold hit $5,589.38 per ounce, an all-time high in human history, the highest price ever recorded for the metal that has served as a store of value for 5,000 years. Then, over the following months, gold pulled back. As of this week, gold is trading around $4,170 per ounce, still up over 25% since the start of 2025, still over $750 higher than 1 year ago. JP Morgan's research team is forecasting gold reaches $6,000 by the fourth quarter of 2026. Ed Yardeni of Yardeni Research maintains a $10,000 gold target by end of decade. The World Gold Council just reported that global gold demand hit a record high in Q1 2026, 1,230.9 tons, generating a record $193 billion in quarterly demand value. China alone imported 317 tons of gold in the first quarter of 2026, nearly 3 times the previous quarter. The People's Bank of China ramped its reported purchases from roughly 1 ton per month to 8 tons per month. These are not speculative numbers. They are documented facts from official sources. So today I want to do something different with this data. Instead of telling you whether gold is going to $6,000 or $4,000, which I genuinely don't know and neither does anyone else, I want to tell you what the gold price is telling us about the state of the American and global financial system. Because if you've been watching this channel for the last 9 episodes, you've heard 9 separate stories about 9 separate crises. The retirement savings crisis, the K-shaped economy, the housing crisis, the insurance crisis, the Social Security 2032 deadline, the national debt trajectory, the credit card survival debt crisis, the Gen Z financial nihilism moment, the AI infrastructure bubble risk. Every single one of those stories shows up in the gold chart as a data point. Gold isn't just a commodity, it's a measurement device. And right now, it's measuring something important. Welcome to Earnings Per Page. Honest finance, no hype. Hit subscribe. Let's get into it. Part 1. What gold actually is and what it isn't. Let me establish the honest baseline before anything else. Gold is not a guaranteed inflation hedge over short and medium time horizons. 5 to 10 years, gold has significantly underperformed equity markets. From 1980 to 2000, the S&P 500 returned approximately 17% per year. Gold fell from over $800 per ounce to under $300. Anyone who held gold through that 20-year period was devastated in real purchasing power terms. Gold is not a productive asset. It pays no dividend. It generates no earnings. It creates no economic value while sitting in a vault. It has no intrinsic cash flow to discount. Warren Buffett has made this point consistently, that gold's value depends entirely on someone else being willing to pay more for it in the future. And Buffett is not wrong about that. What gold is the world's oldest and most liquid measure of confidence in fiat currency systems. When confidence in governments, central banks, and paper money is high, gold is unattractive. When confidence is eroding, gold rises. This is why the gold price at any given moment is arguably the most honest vote on the health of the global monetary and fiscal system. And the vote right now is, the system is under stress. Part 2. The 9 signals showing up in the gold chart. Here's the framework that connects everything this channel has covered in the last 9 videos, and why each story adds upward pressure to gold. Signal 1. The retirement savings crisis. The median American worker has $955 saved for retirement. 70 million Americans are depending on Social Security, which faces a 22% cut in 2032. When people feel economically insecure about their future, demand for stores of value rises. Signal 2. The K-shaped economy. The top 10% are thriving. The bottom 50% are struggling. When monetary policy consistently favors asset owners over wage earners, as Piketty's are greater than G framework predicts, trust in the monetary system itself erodes among those being left behind. Signal 3. The housing crisis. 242 cities now have $1 million starter homes. Homeownership, the traditional primary store of household wealth for middle-class Americans, is increasingly inaccessible. When the traditional path to wealth accumulation is blocked, alternative stores of value become more attractive. Signal 4. The insurance crisis. Health premiums up 58% in 1 year. Home insurance up 46% since 2021. Climate uninsurability threatening $13 trillion of mortgage debt. Household financial fragility is rising across all dimensions simultaneously. Signal 5. Social Security 2032. The trust fund depletes in 6 years. A 22% cut is the official government baseline if Congress does nothing. Every American who understands this reality has a slightly stronger motivation to hold assets that governments cannot devalue by legislation. Signal 6. The national debt trajectory. $39.2 trillion, rising to 120% of GDP by 2036. Jamie Dimon warns of a bond crisis. Ray Dalio warns of a spending squeeze. Henry Paulson warns of a vicious fiscal crisis. When the world's most respected financial minds publicly question the trajectory of the world's reserve currency, gold rises. Signal 7. The credit card survival debt crisis. $1.25 trillion in credit card debt. Average APR at 21.52%. 42% of Americans expect debt their entire lives. Financial desperation and distrust of the economic system correlate with rising gold demand. Signal 8. Gen Z financial nihilism. A generation priced out of housing, burdened with student debt, and watching every crash get bailed out before they can buy in. When the rules of the game feel rigged, alternative assets become more attractive, including gold for some, crypto for others. Signal 9. China's strategic accumulation. This is the most underreported driver of the 2026 gold price. China imported 317 tons in Q1 2026 alone, nearly 3 times the previous quarter. The People's Bank of China ramped from 1 ton per month to 8 tons per month. This is not individual investor demand. This is a sovereign state making a strategic decision to hold gold instead of dollars. The most likely motivation: China is reducing its dependency on US dollar reserves. If the US weaponizes the dollar through sanctions or asset freezes, as it did with Russian reserves in 2022, China wants assets that can't be frozen. This sovereign accumulation is arguably the single most important structural driver of the gold price in 2026, and it is almost entirely absent from mainstream US financial media coverage of gold. Part 3. What James Rickards' framework tells us. James Rickards is a former general counsel for long-term capital management, yes, that LTCM, from Video 21, who went on to become a financial advisor to the Pentagon and CIA, and wrote what is generally considered the most credible modern case for gold as a monetary asset. His book, The New Case for Gold, published in 2016, made 3 central arguments that are more relevant in 2026 than when he wrote them. Argument 1. The international monetary system has collapsed 3 times in the past 100 years and is likely to collapse again. The gold standard ended in 1914. The Bretton Woods system collapsed in 1971 when Nixon took the dollar off gold. Each collapse was followed by a period of chaos and then a new system. Rickards argues that the current dollar-dominated fiat system, which has existed since 1971, is showing the stress patterns that preceded both previous collapses. Argument 2. Gold's fair value based on historical monetary ratios is dramatically higher than current market prices. Rickards calculates the theoretical gold price needed to back the current level of global money supply. Not at 100% backing, but at a modest 40% backing like the Fed maintained in the early post-Bretton Woods era, and arrives at a number in the range of $10,000 to $15,000 per ounce. This doesn't mean gold will reach those levels. It means that by one credible measurement framework, gold at $4,000 is still significantly underpriced relative to the money supply it nominally backs. Argument 3. Central banks are the most important gold buyers and their behavior predicts future price direction. In 2016, Rickards identified central bank accumulation as the leading indicator for gold prices. In 2026, central banks bought a net 41 metric tons of gold in May alone, according to the World Gold Council. The People's Bank of China is ramping purchases significantly. Russia continues to accumulate. This is precisely the pattern Rickards described as the setup for a sustained gold bull market. Part 4. The 3 honest scenarios for gold from here. Here's where I need to be genuinely honest rather than giving you false certainty. Nobody, including JP Morgan, including Rickards, including any analyst on any platform, knows where gold goes next. What we do know is what the 3 plausible scenarios look like. Scenario 1. JP Morgan is right and gold reaches $6,000 by Q4 2026. This requires the current drivers: geopolitical tension, central bank accumulation, dollar weakness, inflation uncertainty to persist or intensify. JP Morgan global research analysts expect gold to push 6,000 per ounce by year-end, and 6,300 per ounce is a possibility for 2027. If the US-Iran situation escalates further, if the dollar continues its weekly decline trajectory, if central bank buying accelerates, this scenario is plausible. Scenario 2. Gold stabilizes in the $4,000 to $4,500 range. Gold is stuck in a bit of a technical no man's land above the 200-day moving average around 4,340 per ounce, and capped for now below the 50-day moving average at 4,730 per ounce. If geopolitical tensions ease, specifically if US-Iran talks produce a genuine agreement, the safe haven bid evaporates. If the Fed raises rates in September, as some still expect, that increases the opportunity cost of holding non-yielding gold and pressures the price. With growing worries that the Fed might have to respond to energy-driven inflation with hikes, gold is on the back burner for most investors at the moment. This is the most likely near-term scenario based on current data. Scenario 3. Gold corrects sharply. If the Iran conflict resolves completely and quickly, removing the primary geopolitical driver, gold could retrace significantly toward the $3,500 to $3,700 range. The structural buyers, central banks, Asian retail, sovereign wealth funds would cushion the fall but not prevent it entirely. Part 5. What this means for your portfolio. Here's the honest practical section, and I'll give you the same framework Rickards actually recommends rather than telling you what I personally do with my money, which is none of your business and not relevant. Rickards' portfolio recommendation for non-professional investors, built over years of writing and speaking on this topic, is a 10% allocation to physical gold or gold equivalent instruments. Not 40%, not 80%, 10. His reasoning: gold is insurance, not an investment. You don't buy insurance hoping to use it. You buy it as protection against scenarios where everything else fails simultaneously. At 10% of portfolio, a doubling of gold prices adds 10% to your total portfolio. At 10%, a 50% crash in gold costs you 5%. The downside is limited. The upside matters when it matters most. The honest caveat: gold at $4,000 per ounce after a 25% annual rise is not the same risk-reward as gold at $1,000. The structural case is intact. The near-term price risk after a significant run is real if you have zero gold exposure today. Adding some exposure makes rational sense given the 9 signals this channel has documented. If you're already heavily allocated to gold, the current technical picture argues for patience rather than chasing. Final verdict on the new case for gold. Should you read it? Yes, if you want to understand gold as a monetary system rather than a commodity trade. Rickards is credible, data-driven, and intellectually honest about what he doesn't know. My rating, 8 out of 10. The monetary system analysis is exceptional. The specific price predictions have been directionally correct, but temporarily early, which is the honest limitation of all long-term commodity forecasting. The bottom line for 2026: between June 2025 and June 2026, gold's price rose from $3,303 to $4,008 per troy ounce, a dramatic increase that raises questions about how high it will go. Gold at $4,000 in July 2026 is simultaneously high by historical standards and potentially underpriced by Rickards' monetary framework. The 9 crises this channel has documented: retirement, K-shaped economy, housing, insurance, social security, national debt, survival debt, Gen Z nihilism, AI infrastructure risk, are all showing up in the gold price. Each one adds pressure. None of them are resolved. The gold price is not an investment thesis. It's a diagnostic tool. And right now, the diagnosis is something is wrong with the system. And a growing number of the world's most sophisticated financial actors are moving toward the oldest store of value in human history as a result. Whether that means you should own gold is a question only you can answer based on your own financial situation, time horizon, and risk tolerance. What I can tell you honestly is that ignoring what the gold price is saying about the state of the financial system is the wrong response. If this connected the dots across everything we've covered, subscribe to Earnings Per Page. I've now spent 37 episodes documenting the most important financial stories of 2026. Next time, I'm pulling back and looking at the single most important investing decision most Americans face in the second half of 2026, whether to stay the course with index funds when everything looks uncertain or whether to adjust. Drop a comment with how much of your portfolio you currently hold in gold. See you in the next one.